Good afternoon, Phoenix members, our guest speakers, registered audience members here in Zoom, and as well as our viewers on Facebook and on YouTube. Welcome to our Phoenix webinar entitled The GameStop Saga. Why and how it happened? Can it happen here? This is brought to you by the Capital Markets Development Committee of Phoenix. To start us off this afternoon, may I ask you to please put ourselves in the presence of God for the opening prayer. In the name of the Father, of the Son, of the Holy Spirit, amen. Dear God, thank you for all the blessings you have bestowed upon us. We are truly grateful for them. Thank you for allowing us today to meet and share our knowledge and time with one another in this webinar. May we extend our divine wisdom to our speakers so that they would be able to impart effectively their given knowledge to all of us. May they be blessed as they continue to bring their expertise to all of us. Bless the participants as well, so that they would be able to glean the vital information from this activity. May you bestow your blessings after this webinar so that we may go out and spread what we learn in the spirit of your love and generosity. May this activity glorify your name. Amen. In the name of the Father, and of the Son, and of the Holy Spirit, amen. Please remain in attention for the Philippine National Anthem. Good afternoon again, everyone. So my name is Michael Guarin. I'm the Vice President for Internal Affairs of Phoenix, and I'm a member of the Capital Markets Development Committee. May I now call on our Phoenix 2021 President, Attorney Francis Ed Lim, for his opening remarks.
Thank you, Mike. Hello.
We can hear you, Francis. Go ahead,
Okay.
please.
Good afternoon to one and all. A special welcome to our students from J Phoenix, who together with their teachers, I'm informed, are joining us this afternoon. Welcome to our speakers, Commissioner F. Amatong, PSECO Roel Refran, Mr. Dino Pade, my colleague in Sherfield of Call, and my friend Anton Periquet. Welcome to our webinar, The GameStop Saga, Why and How It Happened. Can it happen here? Thank you to the Phoenix Capital Markets Development Committee, spearheaded by Chairperson Tess Rabalo, Vice Chair Malu Cristobal, and Liaison Director Sondy Garcia, for organizing this very timely webinar in record time. Recently, GameStop has suddenly become a buzzword in the stock market arena. This brick and mortar video games retailer has been registering low losses even before the pandemic. After years of downward movement of the stock, its share price suddenly increased to as much as 7,200%. What happens next? Can it really happen here in the Philippines? Is there a violation of our securities laws if it happened here? Or is this a form of investor activism in the stock market? The unusual trading activity of stock was, at least based on records or reports, driven by day traders and Reddit users who have urged each other to keep buying shares despite GameStop's elevated valuation. By all accounts, it is an internet-fueled momentum trade. I can share my own observations and insights on the matter, being a stock market practitioner, but I leave it to our distinguished speakers. And indeed, we're very privileged to have with us a global market specialist, the largest online broker in the Philippines, an exchange operator, and a regulator who will share with us their thoughts on the roller coaster ride of GameStop. Once again, thank you very much for accepting our invitation, Commissioner F. Roel Refran of the PSE, Tino Bate, and Anton, my friend Anton Periquet. I know you're all looking forward to this webinar. I hope we can all learn from it, and please enjoy the rest of the afternoon.
Thank you. Thank you, Francis. So what we will do now is to do short introductions of all four speakers at one go. This will allow us to move more efficiently later this afternoon. So for the first speaker for this afternoon will be Mr. Antonio Joseu Periquet, or Anton. He is a grizzled veteran in the Philippine management, investment, and capital markets arena. His insights, either on business or industry outlooks, are always valued. He currently sits on several boards as chairman, four of them to be exact. He is the chairman of BPI Asset Management and Trust Corporation, Camden Hill Group Inc., Camden Hill Advisors Incorporated, as well as Pacific Main Properties and Holdings. He likewise is a director of several companies, both at the holding and operating levels, spanning several sectors from banks, retail, food and beverage, mining. Just to name a few, he is a director of Ayala Corp, BPI, DMCI, the Maxis Group, Philippine 7, Semirara, and Albizia ASEAN Tengara Fund. He is a trustee of Lyceum of the Philippines University and is a member of the Global Advisory Council of Darden School of Business. He has been awarded many times over by the Fund Managers Association of the Philippines as the Best Strategist of the Year and the Best Analyst of the Year. And in fact, in 2002, he was awarded by Asia Money as the Best Philippine Analyst. So again, welcome, Anton. Thank you for accepting our invitation. So Anton is our first speaker. Then as mentioned, Anton will be followed by Mr. Conrado F. Bate, or Dino Bate. So Dino is currently the President and Chief Executive Officer of Call Financial Group Incorporated, the largest online stock brokerage firm in the country, with close to 450,000 clients and over 100 billion in client assets. He has extensive experience in the Philippine stock brokerage and fund management industry. Prior positions that he held would include VP of JP Morgan Securities in the Philippines, President and CEO of Abacus Securities Corporation, VP of Fund Management Division of Philem Life Insurance Company. Dino was a member of the Board of Directors of the Philippine Stock Exchange and served as its chairman of the Investor Education Committee and member of the Legislative Committee. So once again, welcome, Dino, to our webinar. For our third speaker, so this afternoon session will not be complete without a representative, of course, from the stock exchange. Let's all welcome our third speaker this afternoon, Attorney Roel A. Refran. He is the COO and Senior Vice President of the Philippine Stock Exchange. He is a professor of law at Ateneo de Manila University and De La Salle University College of Law, as well as an adjunct faculty at the Asian Institute of Management. He is a professorial lecturer at UP Diliman, Virata School of Business, where he was likewise conferred the Distinguished Alumni Award in 2014 in recognition of his valuable contribution to the capital markets and his role in enabling national economic development. Attorney Refran is a member of the Commercial Law Department of the Supreme Court's Philippine Judicial Academy. He has been awarded the Joaquin G. Bernas Professorial Chair by the Ateneo University for 2020 and 2021. And we'd like to add that Attorney Refran placed fourth in his bar examination batch. And before that, he was likewise one of the top notchers in the CPA licensure examinations batch. So again, thank you for accepting our invitation, Attorney Refran. And last but not the least for this afternoon's webinar, we will hear from Commissioner F. Amatong of the SEC. So Attorney Efiro Luis V. Amatong, or Attorney Amatong, was appointed as Commissioner of the SEC in 2014. And he is currently the Supervising Commissioner for the Markets and Securities Regulation Department and the Economic Research and Training Department. Before joining the SEC, Commissioner Amatong was an Assistant Secretary of the DOF, where he had an active role in the privatization of the Food Terminal Incorporated. He was likewise involved in a number of PPP projects, such as the PPP for School Infrastructure Project Phase 1, the NAIA Expressway Project, and the Automated Fare Collection System. He also served in various capacities in the government, namely as Vice President of the PDIC, Corporate Staff Officer of the NPC, or National Power Corporation, and Acting Chairman of LUA, Local Water Utilities Administration. He holds a Master of Laws degree, International Finance concentration from Harvard Law School, Bachelor of Law from the UP College of Law, and a BS in Business Economics cum laude from the UP School of Economics. Once again, we would like to welcome you, Commissioner F. Thank you. So, without further delay, may I call on Anton for his presentation. The floor is yours, Anton.
Thank you, Mike, and good afternoon. Let me just pull up my slides here. I'm just trying to go into a slideshow here. Okay, can you all see this?
Yep, we can.
We can.
So good afternoon to all, and thank you, Phoenix, for having me here. We are going to talk about the GameStop phenomenon. So GameStop. Okay, I know the action is all about the stock, which became a bubble, which a week ago just burst. But as Warren Buffett advised, before you look at the stock, you first look at the company. So let's just do that. Now, GameStop, what is the company? GameStop is the world's largest retailer of video games and video game consoles. It's a company based out of Dallas, Texas, and at its peak, it had 5,700 stores, mostly in the US, but really all over the world. They do not have a store here in the Philippines, but if you look at the inside of one of their stores, you could quickly recognize a store that we do have here, a chain called Data Blitz. It's a small retailer of game consoles and the video games, the physical discs, that has locations in different malls, from Park Square to Rockwell. You will surely recognize it. Data Blitz is the name. If you have kids, I'm sure you have stepped into a Data Blitz store, or if you yourself are a gamer. But that is GameStop's business, the retailing of video games and video game consoles, brick and mortar, traditional fashion. GameStop went public in 2004, before which they were owned by another venerable brick and mortar retailer, Barnes and Noble, the bookstore retailer. They went public in 2004. They initially did well, but like all brick and mortar operations, they found their business model increasingly challenged and disrupted by online retailers like Amazon. So you see here, in 2016, profits peaked at $400 million, plateaued, and then started to fall before sharply collapsing in 2019. You likewise see the share price of the stock, which fell actually 2 years before profits started to fall. And that is the way markets work, right? They discount the future in advance. Share price came under pressure until finally in 2019, the company hardly made any money and the stock price had fallen to single digit levels. So this brings us to this sets the stage for our story for the day. GameStop, which was facing an existential crisis at the end of 2019. Moving on to 2020, the GameStop Saga. So you have here the stage set, where in 2020 the COVID pandemic hits. So young people are locked down in their homes with nothing to do, bored, but with money to spend. Again, courtesy of the very generous ayuda that the US government handed their citizens, $800 a week, in many cases more than what these young people were earning while they were working. And as you know, sometimes there is little that is more dangerous than young people who are bored with lots of money to spend. It was a time of zero interest rates, a time of zero commissions on trading stocks. Social media enabled the sharing of ideas via discussion forums such as Reddit. Financial populism is in the air. There is anger over increasing income inequality. There is anger at Wall Street, personified by the evil hedge fund who short stocks and send their prices down. And there is, of course, greed, which there always is. Again, epitomized by the millennial mantras of YOLO, which means you only live once, and FOMO, fear of missing out. Now, who are the actors in this drama? So you have the bad guys, the hedge funds. You have the good guys, the Reddit retail army. Reddit, by the way, is a discussion forum aggregator which allows you to share ideas with each other, with other Reddit users. The hero is a 34-year-old American named Kendall Gill, based in Boston, who goes by the name Deep Effing Value. He's an active participant in Reddit, and he's got a YouTube channel with 164,000 subscribers. The enablers in this story are Reddit and Robinhood. You might say the call equivalent in the US, an online broker that does not charge commission on trades. You can see by its very name, Robinhood, they have captured the spirit of the young idealist millennial. For Robin Hood was a folklore character that robbed the rich and gave to the poor. You have the cheerleaders on both sides of the divide, the political divide, Democrats and Republicans, who egged on the Reddit army. And you have the mighty SEC, the regulator, which was conspicuous in its sitting by the sidelines while this whole drama unfolded. Now, Act 1 starts when the pandemic hits. Suddenly, no one can go to the malls, no one can go to the stores. So the brick and mortar retailer, Reddit, GameStop, suddenly starts incurring losses. Its share price falls, and like we said, this is an existential crisis. Is this company going to go under? The hedge funds smell blood, and short interest in the stock hits 100%. Now, it might be useful for the college students in the audience to make a short digression and explain exactly what does it mean to go short on a stock or to short a stock. Going short on a stock is the opposite of buying a stock, but selling it without owning it. You go short because you believe the stock is going to fall, and so you borrow the stock from someone who owns it, you sell it at today's price, you buy it back, say 6 months later when the price has fallen, and having bought it back, you return it to the owner and pay him a little interest for borrowing that stock. And so you pocket the difference between your sale price and your purchase price. So this chart shows you it is the ratio of short interest to total shares in the company, in this case GameStop. And it shows you that virtually every share out there that was existing had been shorted, borrowed and shorted by the hedge funds. Now, the dangerous thing when sentiment is one way on a stock, in this case bearish, is that all you need is a little bit of unexpected good news for the stock to pop. If there is good news, buyers come in, share price moves up, and the hedge funds have to cover their shorts by closing their positions, buying the stock, further driving the price up. That is what is called a short squeeze. And this is exactly what happened in the third quarter of 2020, when the company was still racking up losses by the hundreds of millions of dollars. Now, what exactly happened in the third quarter? In September of that year, the owner of a highly successful pet food online retailer bought 13%, a 13% interest in GameStop. When he bought into the company and disclosed it, it encouraged the bulls who thought that here we are, an expert on online retailing who's done it, suddenly buying into GameStop, and could he turn around the brick and mortar retailers' fortunes? So the bulls come in, they buy up the stock, it doubles. The hedge funds scramble to cover their positions, and the stock doubles again. So here we are in a dilemma. The company is losing a lot of money, but the stock has quadrupled or quintupled. At which point the hedge funds say to themselves, well, listen, if online gaming disrupted old-fashioned retailing, brick and mortar, online gaming itself for games is being disrupted by streaming services. Just like now, few people actually buy DVDs or CDs from Amazon. They actually use Spotify or Netflix. You can do the same with games. You can download them via Game Pass, for instance. So they said even that model is not going to turn this company around. So therefore, let's go all in and continue to short the stock. So you see here, short interest rose again back to 100%. In fact, it exceeded 100%. There, that's the right chart. Now we enter Act 3. Our hero enters the stage. Deep effing Value makes his pitch. And this is a well-quoted pitch now, which he did in both his Reddit forum and YouTube, where he says, I think this stock is very undervalued. I have never seen bearish sentiment so heavy on a stock that towards the end of the year, when they release new models of consoles, this stock is going to pop. Long and short, that's what he says. And just think, he's got 164,000 followers on YouTube. If each one of those followers bought $1,000 worth of stock, that would constitute $164 million of buy orders on the stock. So what happens now? The stock pops on January 13. It rises 50% from just under $20 to 31. And at the 30s level, there ensues a tug of war between the hedge funds that continue to short the stock and the retail followers of deep effing value buying up the stock. So there is a tug of war. It looks deadlocked in the 30s. Then we enter Act 4, where the Reddit army enters the fray. And these are investors with different motives. Some of them are genuine traders who want to trigger a short squeeze, but others are simply buying stock on the basis of ideology. They just want to punish the hedge funds and make sure that the little retail investor wins this battle. So they come in, and you see here the strength of the retail army overnight, where participants on Reddit's Wall Street Bets forum rise from 1.7 million at the beginning of January of this year to 8.5 million in a matter of 2 to 3 weeks. And so you have retail investors now all over the world buying GameStop shares in order to defeat the hedge funds. Now, what happens next? So the share price breaks above 40. The battle continues, but it looks like the force of the retail army is too much for Wall Street's hedge fund royalty. And finally, on January 26, the stock pops. The hedge funds capitulate. They cover their positions, driving the stock even further up. And GameStop reaches a price of $347.50 per share. Intraday, it actually hit $480 per share for a massive, as Francis mentioned, 7,000% gain. You also see here on the extreme right-hand column how volumes of trading in the stock simply exploded. Act 5, the alarm bells start to sound, where essentially responsible politicians, government people, and analysts, including Bloomberg itself, start to say the stock has now risen a value that no longer resembles the worth of the company, that we might actually have a situation here where the winners actually end up the losers. Because as we all know from history, bubbles eventually burst and share prices come back to reflect the real value of the underlying company, which, remember, was still losing money up to that point. Then a very strange thing happens the day after the stock hits an all-time high. Robinhood, the online broker, announces that it can no longer handle the volume and value of trades because its working capital is not enough to clear the stock trades, that it decides to limit buying of GameStop to regulate the purchases. This, of course, causes a collapse in the share price by 50% and an outcry among the retail investors. There is an outcry as well among the politicians who say that Robinhood is in collusion with the hedge funds, and Robinhood scrambles and is able to raise $1 billion overnight of working capital to resume the normal trading of GameStop's shares the very next day. The stock pops back above $300, but then, presumably because of the warnings that are sounded, it starts to fade and the retail army runs out of ammunition. The stock falls below 200, below 100. It settles somewhere here at 50. The story is not yet over, but pretty much we know how it's going to end. And that is the GameStop saga in a nutshell, as you can see from us captured by this chart. It is the story of a bubble that reached massive proportions in terms of price gains larger than the 500-year-old tulip bubble craze, but simply ended in 2 or 3 weeks. Now, who are the winners and losers from this drama? On the surface, it looks like the hedge funds won this war, but many of them got burned. Losses totaled as much as $20 billion, and two prominent hedge funds had to be bailed out. You were a winner if you were a hedge fund that came into the game late, as the retail army was running out of ammo, but a loser if you came in too early. Some retail investors also won, those who came in early and were able to sell as the stock rose. But those who came in late, buying on momentum, probably lost everything. And some of these buyers were college students who were gambling with their tuition money. Perhaps the biggest winner of all was Ryan Cohen, the owner of Chewy, the online pet food retailer, who saw his $76 million stake balloon to $2 billion in a matter of months. If he was smart, he would have sold some of his shares. Uh, and that is what some old GameStop institutional investors did, as well as many of the executives. Reddit was a clear winner because their usage exploded. They were able to command a private equity valuation of $6 billion because of the episode, and they opportunistically raised $250 million very quickly. Robinhood was a winner, again, because their customer base ballooned. The Worldwide Robinhood Society, based in England, which had 1,000 Twitter followers up to the end of last year, was mistaken for the broker, and so they gained 60,000 followers overnight. And finally, our hero, Keith Gill, whose $700,000 bet on the stock, I mean, he's an amateur investor, but it seems someone with money, turned into $48 million at the peak, and today is still worth $13 million, assuming he has not sold anything. Now, the losers, like we said, the hedge funds who were burned, those who played too early, the retail investors who came in too late. Robinhood also came out on the losing side because they now face class action suits from investors who felt that they were responsible for bursting the bubble by restricting trading for that one day. And Keith Gill himself was a loser because it was discovered that he made his trades while he was still employed as a financial advisor at a Boston firm where he was supposed to report his trades but did not. And so the industry is now considering banning him for life. So that is the GameStop drama in a nutshell. To quickly answer the question posed by the moderator, can this happen here? Some parties say it cannot because short selling is not allowed and because minimum broker commission rate is 25 basis points. So it is expensive to trade if you were just an amateur. Some parties would say yes, it can happen here because even if short selling is not allowed, the minimum free float requirement for companies to list on the exchange is only 10%. I know it's 20% for companies, but for companies that were listed before 2017, it's only 10%. So you have a lot of companies there that are very thinly traded, and it's very easy to push up their stock and do a pump and dump operation on these stocks. Secondly, there is a minimum commission rate, but brokers dealing for their own accounts do not have to pay this commission. And finally, there are the incentives. Convictions here for market manipulation are rare, if ever. The last major one I remember was the Best World or BW scandal, where manipulators drove up the stock price from 1 peso to 100 pesos before the stock collapsed again back to 1 and burned so many retail investors. I think 8 or 12 brokers were convicted, were charged and convicted and fined by the SEC. But the fine was only 50,000 pesos per broker. So if you were a market manipulator, you'd think, I stand to make, look at my upside. I stand to make millions of pesos with a pump and dump operation. But okay, if I'm caught, I pay 50,000 pesos. So what does that incentivize you to do? Now you may ask where I stand on this divide, and I stand with the yes camp. And I don't even need to justify my stance because the proof is that it happens here all the time. And I will leave you with a chart here of a stock that has risen almost 1,000% in 1 month and has since collapsed in half, and who knows where it's going from there. And there is no regulation or intervention by the market surveillance authorities. So, on that note, I will end with the paraphrase of a quote from Warren Buffett, whose philosophy is when you invest, always remember you are buying a share of a business and not a piece of paper. So, buy the business, not the stock. So, that concludes my portion, and I'm happy to pass you over to the next speaker. Thank you.
Thank you, Anton. That was very, very clear and very informative. Um, Up next is Dino. Go ahead, Dino.
Okay, hi, good afternoon. Welcome everybody to this briefing, and I'd like to thank the Capital Market Development Committee for inviting me to share our view of what's happening in today's environment here locally. I think this phenomenon of the rise of retail investor is not only happening in the US, but everywhere in the world, including the Philippines. I guess this pandemic has created this opportunity for people to start exploring new activities in their lives that could either be helping them to keep them busy as they are bored at home and have nothing to do. And now that the stock market is readily available for everybody because it's now online, they all started to delve into it. So let's just look at what happened here in the Philippines. I guess because of what has happened, the pandemic has really created this opportunity to attract new investors. So next slide, if you look at this, you can see that the stock market in 2020 fell from its peak as much as 50%. And this attracted a lot of new investors in the market who have never invested before in the stock market. As you all know, slightly more than 1% of our of the Filipinos are invested in the stock market. So the opportunities like this that we see, whether it be in 2008 or in 2020 during the financial crisis in the US and here during the pandemic in 2020, we always see a lot of people rushing into the market because they always say, I've never invested before. This is my chance to do so. And that's the reason why they're all excited when they see this kind of sharp drops in the market. And because of the growth in the online broker community, we are now over 20 of us who are now offering this service. It now made it very easy for these investors to participate in the market. Signing up was all done online. You didn't have to go to the offices of this brokerage house anymore. You just had to do it all online. And you can do withdrawals and deposits in the same manner. So it was really with a click of a mouse that you could really access these markets, and they had full control and flexibility in managing their investments. Of course, in the early part of the year, there was a lot of uncertainty and the market started to pop and it bottomed in March. And this created a buzz in the market, and that created more people to start looking at the opportunity since there was not much alternative out there for them to grow their money. So there was this captive audience of young traders who were lured by these social media influencers who were very, comfortable in the digital space, and they started to look at, this different forums and investment groups that they could join, and they were, hearing about the ability to make a quick buck in the market, and that created this buzz in the retail sector. Next slide. If you look at the next slide, you'll see that the average trading volumes of the market, if you look at from the right on the left side, 2018 to 2020, there was not much change in terms of total transactions in the Philippines. But what you'll really notice is really the dark blue shaded portion. You can see that the local investors were now becoming more active. And this was driven by the retail investors, which I will prove to you in the next succeeding slides. So in January, you can see that it continued on, and we had about over 22 billion transactions, and that was majority coming from what we call the local investors. Next slide. So you can see that, in the past, our markets have been dominated by foreign flows, which is always, slightly more than 50% or even as much as 60 or at times even 70% when there's a rebalancing going on. But slowly you can also notice that the retail investors or the local investors started to gain more, traction. You can see that in January of 2021, they now cornered as much as 75% of the market, which was not seen, in any time in my history in delving in the local markets. Next slide. And you can see that the kind of stocks that they were buying were really what we call second liners or non-index issues. In the past, it would always be a balance between index and non-index issues that our clients would be buying. But we noticed in 2020, there was a change. There was a big shift. They're now going into more what we call second liners. I guess they felt that there was a greater opportunity to make money in these issues, not only because they felt that the index issues were expensive, they just didn't have really any sexy story that would drive the price. And these were also owned by mostly the professionals. So they wanted to look into issues that were not held by these professionals and where they could participate and have a better chance of lifting prices. So you can see that the number of transactions likewise ballooned, which caused a lot of online brokers to really suffer in terms of capacities, and there was a huge lag in our systems. People were having a hard time executing orders. People were also having difficulty looking at the prices because the systems were not built to take on this kind of load. We saw transactions growing by 2 to 3 times what it was in the past, and that was not something that we were all prepared for. We were always looking at a number of about 50% every year increase, and this time it was just caught everybody flat-footed with this surge of activity from the retail investors. Why did this happen? You can see that here are some of the retail favorites. If GameStop made 7,000% return, you can see, look at the retail favorites. They're not all speculative. They're not GameStop quality. Some of them are companies that are properly managed, and have good businesses, and have a great story to tell. But look at the returns that they have. They have about as high as 15 times from the low of 2020 to just 7 times from 2020. Also in 2020. So this kind of returns was very hard for these people to turn away from. They were attracted by it. They said, wow, this is really so easy. You can just now buy a stock and tomorrow you can even double your money in a very short period of time. And so that was created the frenzy in our market. Okay, but we got to understand that there's this new breed of investors that are coming into our market. Of course, these people are more what we call motivated and confident, that they feel that because of their access of the information in the internet and these forums that they're able to join, they feel that they're more equipped, take the risk and make informed decisions. So in 2019, our customer base, bulk of it really were about the 30 to 39-year-olds, about 40%. This is the COL retail demographic. But in 2020, we saw a big shift. It was now the much younger group. It was students to early employed, early in their employment journey of customers who were below 30-year-olds. So there was about 51% of them that had the appetite for risk and was motivated to try to make money and take advantage of this frenzy that's going to the stock market. Next slide. Even based on the surveys or the account opening forms that they would fill up, and we would ask them their knowledge, the level of knowledge, you can see a big difference in their knowledge. They all believe, or 60% of them believe, that they had limited knowledge already. Unlike in the past, 63% they had no knowledge at all, and they would need all the help from the broker to even just get started and understand what is a stock. Unlike this new set of investors, They just said, you know, they all want to know, how can you help me? I want to make as much money in this market. How can you help me? Because I want to participate in these different stories that are going on in the market. And that's why they had to join different forums outside of the brokerage, industry, because the brokers, particularly COL, was not providing them the information that they needed. All we did was try to warn them about the risk of speculating in these issues. Next slide. Even look at the size of the kind of occupation of these people. Bulk of them are still employed. They all have money, they have some savings, and they all are, gainfully employed. So about 73% are still employed, while students are slowly picking up. They're now 5% of our base, and the OFW is also likewise have picked up. Next slide. In terms of number and amounts of assets that they control, we also review this very carefully, and we noticed that although the investors that are below 30 are growing in number, the assets that they control is still very small, about 7% of the base of COL. Bulk of it is still held by these people who are between 30 to 50 years old. And they are what we call the savers, who are now at the stage in their life who are more concerned about the future, or they're starting a family, so they're now putting money aside to invest. While this is what we call the mass retail, because if you look at the slide on the right, a bulk of them are still net worth is about below 500,000. So they're the early stage of their investment journey, very early stage. Next slide. So what is this telling us? You know, if I would look at the similarities and differences between us and Robinhood, I think I just want to walk you through the similarities first. If you can see, Robinhood and COL are both online brokers, as Anton mentioned. You know, we now give access to markets through the internet. And of course, this is made easy and can be, you can do everything from, wherever you are, as long as you have an internet connection. And most of our customer base are what we call self-directed investors. These are individuals, bulk of it are individuals, and they are, they do it on their own. We both offer margin facilities. We give them a chance to avail of margin if they needed so, and that and the next is, of course, they can only trade issues that in our own markets that are listed, and ETFs likewise. Now let's go about the differences. Here's where the difference lies. The commissions of Robinhood were free, and COL is mandated by the regulators or PSE. The minimum commission that we can charge is 25 basis points. The difference between Robinhood and COL in terms of this commission structure is that Robinhood's client was not its customers. They were really they were making money not from this customer. The customer was really their product. And they tried to make money off them by selling their flows to what we call market makers. And these market makers would not be transparent to their clients on how their trades are executed. Unlike in COL, they have direct market access. When they put in a trade to our platform, they can immediately see what price and it was executed at. And they can even see a timestamp that shows it. So they can identify that's my trade. In terms of margin, Robinhood offered it across all customers, regardless of whether you're sophisticated or less sophisticated. If you open an account, you have a margin account automatic. So there was no real screening process. It was just a feature that they gave to the clients because they were trying to nudge them to trade as much as they can. While in COL and all other brokers, it's conditional. We are regulated that we are supposed to give our clients, people more margin with as much, the minimum account balance they should have is 50,000. But for COL, we said it's got to be 200,000. You have to have 200,000 in your account before you can access this facility. And second, each application is reviewed by a committee. It's not automatic. Even if you have 200,000, you say, I want a margin, and we don't automatically give you. It's reviewed by a committee, and the committee has to see that this person has a level of knowledge and is responsible enough to handle a margin account. And the amounts that we assign is not equal to the number, the amount of their equity. It is also designed in such a way that we only assign a figure that we feel that we can risk for this client. So if you have 100 million in your account, you don't automatically get 100 million in margin. We can just say you'll just give it 20 and see how you trade, and see what kind of issues you're buying, and see what kind of behavior you have, and if you really understand what you're doing. I guess this was learned from experiences in the past that we saw that margin could really be a tool that can ruin the capital markets, particularly for the retail investor. And that I guess memory is still very fresh in a lot of brokers' mind. And that's the reason why I think even BW happened, because people were lending individuals crazy money to try to speculate in BW. But this time, that is now being controlled. Second, the only issues that you can use for margin are what we call investable stocks that we have reviewed, our research team has reviewed, and they must have an earning track record, and they must have the liquidity that will allow them to be able to get in and out of stock. And second, the threshold that we require for a margin call is much higher than what the regulators have imposed. The regulators have said that if ever you do a margin call, the levels that they can, the minimum level of equity that a client should have is about 25%. For COL, it's 33%. If you fall below 33%, automatically there's a margin call. The client has to either liquidate or add more money into his account. Based on our history, since we've offered this maybe about 12 years ago, the number of people that we had to do a margin call is really a handful. A handful, and they all topped up when they had, because when they were asked to do so. So you can see that the different mindset of the clients today, that they're very careful too about handling margin, because we make sure they understand what this tool can do. And lastly, of course, is every time they want to increase their margin lines, they always have to go to the same process all over again. We just go to a committee and be reviewed, and the committee will decide whether they're responsible enough to handle a bigger margin facility. Next slide. Here's just some stats on what our margin, how much impact margin has done to the COL business. You can see 2018, 2019, it just gives you a comparison of how much margin has contributed to our volume. And you can see it's less than 4% of our volume is really margin. And even in January, when the markets really, there was a lot of speculation going on in our markets, only 0.9% of our volume was really driven by margin. So it was all cash basis. A lot of trading was done based on the cash positions of clients. In terms of research reports, we both provided research and investor guidance. It's just the manner of how we do it. The research reports of Robinhood were third party, and so there was no, they were not, concerned about its quality, because it was produced by people that they have invited to populate their site with these research materials. Unlike COL, it's in-house, and therefore we feel we're very much accountable for the companies that we promote, and therefore it's very carefully curated. At the same time, investor guidance, we all are being required by regulators, both in the US and in the Philippines, to put all these warnings to clients before they start investing about the risks of investing in the stock market and the different facilities that are made available. In COL, it's just different. We have it in the site, but we also actively educate our clients. In our forums, we always warn them about speculating, and we're telling them, if you are in the business of trying to speculate, you must understand the rules before you do so. And we warn them that 85% of people who speculate lose money, but if they have to do it, there are rules that they should follow. At the same time, any new product that comes out in the market, we try to educate our clients to help them understand the risks and the opportunities of these products, and help them make these decisions, about their portfolios. Okay, the other differences are the other things that that are also made available in the US by Robinhood. Of course, the hedging facilities, derivative products, these are something that we still don't have today. It's not made available, and of course, this also fueled the activity in Robinhood or in the US. And also, of course, the investment products that you can see that Robinhood had were only companies, or issues that were listed in the exchange. They really didn't care about any other investment product because there was no way they can make money if they're going to charge everything for free. And so in COL, we have mutual funds. We're in the business of helping people build wealth by investing wisely. And so we come up with any product that we feel that can help them achieve this objective. In terms of control mechanism, I'm sure that the regulators will, Attorney Refran will talk about this, but even in terms of controls, the controls that they have in the US is very, not as stringent as ours. Our price freeze is limited to 50% in a single day. Unlike in the US, the circuit breakers, they just give you a 15 or 5-minute cool-off period, and after that, it starts again. And the new limit is based on the last price you traded. So companies can grow 100% or even more than that in a single day. Unlike in the Philippines, it stops at 50, and you have to wait the next day. People have a time to review what really happened. Companies have time to disclose what's going on and guide their customers. And of course, the other thing that we also need to put in our system, of course, is our advanced order types, which is not yet available. But these are what we call the market limit orders, stop loss, buy stops. These are all tools that can help manage risk for clients, which we still don't have today. And I think the PSE should now try to encourage to make this available to brokers so that we can now offer this to our clients who can now plan their trades properly and not be sucked into the emotion of trading. And lastly, of course, trade settlement. And most of the trade settlements from Robinhood was mostly leverage transactions as compared to COL, which is mostly cash. I mean, as you've seen, margin is a very small portion of our business. It's really the cash prepaid accounts, and this is the money that our clients have in their accounts. This is the amount that they can only use. Okay, so if I now have to answer the question, can it happen here? I think without this, these complicated financial tools, and at the same time, the way the brokers are self-regulating themselves, given the experiences of the past, I believe it's most unlikely to happen here in the Philippines. Okay, so now that I've talked about advanced question, I just want to just share with, take this time to really just share some of the lessons I think we've learned from what happened in the GameStop saga. The first, of course, is I guess we have to continue to improve. This may not apply here. We may be doing it already here in the Philippines today. But for what happened in the US, I guess they have to really improve the risk management approach, especially for new and less sophisticated investors. Because, Robinhood just gave all these facilities to all types of customers. They never really had to screen the client's ability to understand this and just gave these tools to them to use because they want to nudge them to trade as much as they can. And second, of course, is we have to safeguard misinformation, especially online. I guess these people are, highly motivated. They really want to learn a lot of, maybe about investing, and they're going to different sites to try to learn. So we really have to know how we can provide them with a reliable source of information so that they can go to these sites and really learn what they need and understand what's going on rather than relying on sites that are not, regulated. Next is, of course, is what we also learned that from what I saw from what happened to Robinhood is that we have to treat our clients fairly and equitably. I think this is something that we all have. We work so hard to build this industry and to earn the trust of our clients to invest in the stock market. And that's why it's very important to us that we have to always make sure that our clients are treated properly and that they are given the right information to be able to make well-informed decisions. Lastly, I think this is an opportunity that has created here in the Philippines with this short-term momentum of activity and frenzy that's going to the stock market. The challenge for all of us today is really how do we convert this short-term momentum into something more sustainable in the long term and keeping the interest of the retail investor. We now have them. We've worked so hard to try to, get people to invest in the stock market, and now we're seeing a good segment of them now starting to participate in it. So what do we have to do? First, of course, brokers have to beef up their system. I guess the systems have to be more robust to support the fast-growing investor base. Second, I think we have to encourage more listing. These people are looking for companies that they can, relate to and grow with. And so if we continue to keep these companies, the number of the number of companies that they can choose to a very limited number, you will lose their interest. They're very savvy. They understand. They are motivated to learn and be able to participate in these growth companies. Second is that we have to provide more investment products. Now that we've seen their capabilities, we have to come up with products that can help them genuinely build wealth. I'm sure we know the stock market is very cyclical here in the Philippines, and we can't rely on the stock market to provide that. So we also have to look at products that we can bring in and opportunities for them to participate in other markets, either through mutual funds, UITFs, so they can all, have a more diversified portfolio. Next. And of course, education is very critical here. The investing public is hungry. They're trying to learn as much as they can, and they're willing to take time off from their work to hear and learn about investing. And if you ask them why they're doing it, it's because the answer they normally would give us is, para sa akin to. Therefore, I should really take time to learn this, because if I have to wait for my companies to provide this support until my retirement, it may not happen. So I have to take control now with interest rates where it is today. And the other, of course, the challenge is to monitor social media and web-based investor forums. I don't know how that's going to be done, but I think there is, it's the only way we can really combat this is provide them, easy and understandable access to information. I guess listed companies should make themselves more available to the shareholders, through the use of the internet, and the PSE should make disclosure much easier to access for these people. I know the PSE Edges have such a great app that people can use, but I'm not so sure how many really access it and whether it's that easy for these people to look for the information that they're looking for. So it's really important that we arm them with all this knowledge and information. And lastly, I just want to close it with this. I think we worked so hard to try to grow this capital market, and now we've had this opportunity. And we've seen a segment of investors that are highly motivated to try to build wealth. I think it's our role now to come up with more products and services that will help them to build genuine wealth and arm them with the knowledge to be able to make smart investment decisions. Thank you.
Thank you very much, Dino. Very interesting perspectives. May I call on now PSE, Attorney Roel? The floor is yours.
Good afternoon, everyone. Okay. I'm now here to present our perspectives when it comes to what I call the meme stocks, right? In other markets, they're saying this is probably confined to certain advanced markets, primarily because of the structure in which they are operating in. Now, let's take a look at the Philippines and see what, if any, could be points for us to consider for purposes of regulatory assessment, for purposes as well of risk management. Ultimately, the market structure from the trading infrastructure all the way up to the clearing and settlement is all about managing volatility, managing risks. As we know, similar to the banking sector, there are potentially systemic risks that could emanate from the capital markets. Of course, not in the same way as you would for banks and non-bank financial institutions. And we've heard from the other speakers before me, the anatomy of what is now unfolding before us and creating a lot of discussion. It's a hot topic. We talk about the influence of social media and the investor sentiments that are formed with respect to certain securities being tagged to be the next big thing. And this would definitely drive liquidity as well, as we are also seeing for other markets. And this is, by the way, not just peculiar to the US. We've also seen sentiments around certain stocks in Bursa Malaysia or in the Malaysian market. They had a Top Glove as late as last year also experiencing, because of the pandemic, a lot of investor sentiment, forcing as well the Bursa Malaysia authorities to come up with announcement. In the same way, Singapore Stock Exchange and the Monetary Authority of Singapore as well cautioned investors against meme stocks created by social media chatter. A little bit of history. Back in 2010, we saw the flash crash, right? Back in May of 2010. And this brought about this very sensitive and very animated discussion. In fact, a book came out, and I particularly remember this book back in 2014. This is Michael Lewis of Liar's Poker fame, came up with the book Flash Boys. And the discussion points centered on high frequency trading, as they were seeing that the high frequency traders, or the algos, being utilized by the institutional investors, were creating what they call an unfairness in the capital market, simply because the liquidity is being sapped by the HFTs to the point that the retail investors end up picking up the crumbs, right? The price arbitrage is being taken advantage of by the HFTs and the algos out there, so that the arbitrage opportunities are being realized more and more by the institutional investors, less and less by the ordinary investors. And so the question that was posed by Michael Lewis through the character Brad Katsuyama in this book was, are the markets rigged against retail and in favor of institutional investors, right? Are we seeing a second iteration of the Flash Boys 2.0, I would say, discussion point? But this time around, it's the other way. Are the retail investors now, or the socialist investors, taking now their revenge against the institutionals, as the previous speakers may have also pointed to? Now, I say the genie is now out of the bottle, right? The genie being retail pickup, retail participation, as Dino Bate mentioned, right? The rise of the retail, driven by what? The work from home environment, enabling more and more investors to also be able to trade from home, maybe during the lunch break, maybe even outside of office hours, right? Now, I highlight that there's always been herding behavior, even back before the pandemic started. Herding behavior in the sense that investors tend to congregate and to herd following what they perceive to be the smarter trades of the quote-unquote leaders. Only sometimes the herd may actually be going in the wrong direction, and sometimes would fall off the cliff, as you would probably see in some examples of why we should not herd and just follow blindly, right? And this time around, during the pandemic, what we've seen is there are meme stocks, right? Stocks that are being hyped, being overbought, and positions are really unbelievable compared to the fundamentals, hence being considered to be overvalued in terms of the actual trading value vis-a-vis its intrinsic value, right? So herding behavior over meme stocks. Of course, the genie is out of the bottle. We cannot undo that, right? In fact, it's a good thing that the retail investors are becoming more and more participative. And hence, we take a look as well into stock market investor profile, right? You look at the historical trend, you would see that the direct market access, which is another term we use for the online traders, would account for more than 98% of the total accounts as of our last survey, right? And the online accounts, you would see around 63% of the total in the market, right? The online accounts at 782,000 accounts compared to the more than 1 million accounts in the stock market. And I guess I'd just like to highlight, these are not distinct accounts. There might be double counting, but nevertheless, for our purposes, we are seeing a trend. And the local accounts as well, accounting for the lion's share in terms of the total participation of investors. And this is again at a 98% participation by the local accounts, right? Is this the new normal? The rise of the retail, no? I always say that liquidity has been driven as well by the circumstances surrounding the pandemic, right? As the end of 2020, we were seeing daily averages of just over 7 billion pesos. Year to date, however, we're looking at more than 10, almost 11 billion pesos on a year to date basis. And the drivers of this new liquidity or the new normal, we are looking at the chart and seeing, for example, the retail pickup from a 26.9% contribution last year, 2020, has now almost doubled it, right? It's now at 51% year to date contribution by the retail investors, right? And this really the newfound liquidity, the new normal that we are seeing in the market today. Is this good or is this bad? Well, for us, it's good, as we also see that the local pickup has actually reversed decades-long dominance by the foreign. As we have seen now, 75.5% of the value turnover is now accounted for not by the foreign, but by the local. And that's really a shift in terms of the behavior, in terms of the liquidity drivers in our market. So we believe that this would at least serve as a buffer for any shocks that might be forthcoming, as in when there are global reallocations by the foreign investors, simply because the liquidity providers, the local, would probably still believe in the Philippines as well as the capital markets at the end of the day on a long-term basis, and would not just simply go out and exit the markets, right? There is also this thing called home bias, right? And we have observed this throughout markets. Investors would tend to gravitate towards local stocks, notwithstanding options available to them to as well take advantage of global stocks at the investor level. We as well in the stock exchange have, I would say, empowered the local investors on the subscription side and as well on the market data side. On the subscription side, we have launched what is called an electronic allocation system to allow and enable investors to use their smartphones to be able to subscribe to the local small investor tranche of any initial public offering. And for the past 7 IPOs, we have launched the PSE EC platform with a mobile app to allow the more than 35,000 enrolled investors to not anymore lined up to receiving centers just to subscribe. Now they will just, with a couple of clicks, be able to confirm that they have been subscribed to an IPO, LSI, or the local small investor allocation. Of course, without prejudice to additional subscriptions that they may want to secure from their brokers. So this is on the subscription side. It's a tool, it's an enabler to also equip our investors with more facilities to subscribe. Needless to say, they can only subscribe once they have an account with a broker or a trading participant of the PSE. Secondly, on the market data front, we've always touted, we've always espoused investors to make sure that they are aware of the most recent material disclosures. And this can be viewed free of charge in our electronic disclosure generation portal, or PSE Edge. This would contain not just certain market data stats, as well as the market infrastructure and the disclosures pertinent to each and every one of our listed companies, from the financial statements all the way to material information that may be approved or resolved by the board of directors on a real-time basis. This is very important, as well as we see retail pickup contributing heavily to the liquidity in the market. So going back, DMA, direct market access. This is what we call the direct market access rules, which explicitly provide for risk parameters at the broker level. And what it is, before a system gets rolled out in the market for offering by the trading participants or the brokers, there will be requirements, for example, on order limits, on trade exposures or price limits that they would like to implement by way of risk parameters pursuant to their policies, so that, for example, a local investor would not be trading beyond his or her means. And this is integrated and assessed by the exchange prior to a DMA facility or an online trading platform being launched into production by a trading participant. We also would like to highlight that there's now an easier way to open accounts. The SEC would provide approvals for electronic KYCs, or the customer due diligence requirements. And this has also opened up the avenues or the gates for more and more investors to participate, because face-to-face KYCs can now be replaced by electronic modes by which you can actually ascertain that the investor is a real person and that there are suitability requirements via questionnaires, via provisions of, for example, financial statements, to ensure that the investors' choices of products in terms of the risk parameters match or are aligned. And so the MA, as well as the ease of opening broker accounts, have very much opened up as well the opportunities for investors. Another point that we should consider would be, in the GameStop scenario, there is actually the short selling squeeze, or they call it a short squeeze. And this is a function of their program for short selling, right? Short selling is a standard by which you are able to take, for example, a bearish position on a particular security to the end that you would like to sell it now via borrowed securities. And at the point where hopefully your view materializes, prices go down, then you're able to replace the borrowed securities and buy from the market at a much lower price. Hence, there is that profit that you have generated. Okay. Now, our framework, as approved by the SEC, is of the same parameters. Number one, we do not allow what's called naked short selling. Naked short selling is a practice, trading practice, that we are banning, that we have banned, although our short selling frameworks are yet to be formally approved together with other infrastructure and system changes. Once we launch it, naked short selling is not allowed, meaning you cannot short sell a stock when you have no facility to borrow or to source that stock which you're selling. Okay? What we allow, however, are what's called covered shorts. Covered shorts. How do you cover a short? Via a securities borrowing and lending arrangement from another broker who allows that particular share to be lent to you for a lending fee. And this is normally via what's called a multilateral or a master securities lending agreement at the broker level. So naked short selling will not be allowed. Covered short selling is allowed. And we also have a condition on what can be short sold. Really, it's really the PSEI constituents and exchange traded funds. And these would limit it to the most liquid, to the highest in terms of market capitalization, and to the highest stocks in terms of public float. And the limit that we impose is a 10%. We call this a short interest ratio. Anytime you breach this, you will see that that stock will become ineligible for purposes of short selling, as and when we finally launch the short selling framework. And finally, the optic rule, a universal requirement, regulatory requirement. You go back to the 2008-2007 global financial crisis. In other markets, they suspended the optic rule, meaning you could actually short at a price that is actually lower than the last traded price. And when they saw the impact of that suspension in the optic rule during the great global financial crisis, they realized that they should reimpose the optic rule. In our jurisdiction, the Securities Regulation Code, as a basic requirement, imposes the optic rule for short sales. Optic rule simply says that you can only short at a price higher than the last traded price in the market. And we also would be implementing this on a strict and mandatory basis. Moving on, we are always reminded that markets reflect the sentiment of a variety of investors. And the general function of markets is for investors to express their opinions on a market price or a security. What's a proper price, right? I'm always reminded that an exchange provides for what's called a price discovery mechanism, right? An investor and an issuer would like to list with us in order to ascertain its market price. And they always say, well, the best metric would always be the last traded price or the closing price. And that's a function of capital markets. There's a price discovery mechanism away from just valuation reports, simply because a matched trade reflects a view by the market on what's a proper price. Now, that being said, we also do not espouse the view that our goal is really just to increase liquidity, right? I always say liquidity for the sake of liquidity should never be the goal of a financial or a capital market provider, right? The ghost, quote unquote, ghost liquidity that other markets have seen by the prevalence of HFTs, right? The algo traders, which are really just spoofing all these trades for purposes of getting a sentiment of the market. But in reality, milliseconds later, those trades posted would be canceled, right? And hence, the structure is also lends itself to potential ghost liquidity, right? So what we're looking for is liquidity reflecting, right? Legitimate orders. In our DMA structure, it should be of what we call a parent-child concept, right? You're just using algos coming from an investor convenience, right? You would like to provide benefits to your investor, and algos should be able to guide them in that direction on a parent-child basis, right? You already have a main order, and it could be that that order could be chipped into several pieces, but really, these are legitimate orders, okay? So liquidity for liquidity's sake is never the goal. And that being said, we have embedded in our platforms, in our rules, price thresholds, no? What happened in GameStop, there were days when it went down by 60% compared to the previous close. Over a 2-day period, there was a cumulative 75% drop. Will not happen in our market if you look at a 1-day drop. Why? The static threshold that we have limits the price drop to 30%, although the upside is capped at a 50% upside potential, right? We have the 50-30 static threshold. So that's already integrated in our market. On a trade-for-trade basis, for those who are already investing, you would realize that we also have what's called a dynamic threshold. Any given time, if you post an order and you breach the dynamic threshold, that particular security could actually have what's called the frozen status, right? Simply because it could be an error, it could be a fat finger. And what we want to make sure is that the threshold gives you time to make sure that you're able to manage the risk of error compared to the last traded, right? So dynamic threshold would be dependent on whether you have a liquid stock or a stock that is not very liquid. No, any given time, it could be anywhere from 10% to 20% dynamic threshold on a trade for trade basis, right? So you have the static on the cumulative level, 50 up, 30 down, dynamic on a trade per trade basis, okay? Circuit breaker rule already as well intimated to by Dino earlier. We also have that. We just recently amended it so that anytime the entire market measured by the index, right? We only have a circuit breaker rule on the PSEI or the benchmark index, not yet on the per stock level. So the circuit breaker, anytime the PSEI drops by 10%, we kind of implement a pause, right? Allow everyone to get their bearings, regain their bearings for 15 minutes. If it goes down by 15%, okay, let's do a 30-minute pause before we resume trading. And if it goes down by 20%, it will result to a 60-minute pause. Of course, the automated order matching principle being at the heart of our matching engine. You would see, for example, other measures. We have the SACP on the number 5 item here. We have mark-to-market collateral because as a market operator, we assume the central counterparty obligation, right? Trades will always be between the clearinghouse and the investor on the buy or the sell. This makes sure that centrally cleared trades have almost zero risk when it comes to performance or consummation. And brokers will have to be able to put up collateral when there are negative exposures, and we measure this on a daily basis during the time that the trade is outstanding and the settlement period has not yet lapsed, right? Our settlement period is really transaction date plus 3 days. And finally, the CMIC capital market infrastructure imposes risk-based capital adequacy ratios to make sure that the systemic risk that could be introduced by the broker is also addressed. Now, the meme stocks mania, is this illegal, right? The jury is still out. In our markets, we have the Securities Regulation Code provisions on market manipulation or fraud, okay? There are also questions, or are there really asset bubbles? Is it forming on the basis of price momentum, valuation, leverage, investor positioning, right? In general, emerging markets are not viewed to be asset bubbles. In the same vein, probably that you would see there's an asset bubble in the Bitcoin space, trading now at more than 44,000 US dollars per Bitcoin, as well as the market volatility measures of PSE. Okay, now, key takeaways from our view of the capital markets. Well, we have benchmarked our rules and constantly upgrading them at par with our peers in the region for financial market institutions, both, as I mentioned, on the trading side as well as on the clearing side. Central to our role for investor protection as well as for efficiency and stability of the capital markets is risk management. We have regulations in place at the broker level, regulations in place on the market level in order to make sure that risks are being managed. And finally, we know that this is the new normal. The genie is out of the bottle. The meme stocks might drive liquidity. But that being said, our market's still predominantly a cash market. You might say our derivatives by way of exchange traded funds, warrants, and PDRs, but this is really not yet the derivatives market that we would like to also launch at the right time together with the SEC in order to provide investors with not just a buy and hold position, at least they could hedge their exposures to the market. So finally, the story is still unfolding. We have these market structures and regulations in place, but we are confident that the impact, if any, of the rise of the retail on the meme stocks, you might also say the GameStop probability, we would be better able to cope. And hopefully investors are better protected by all of these infrastructure regulations.
Thank you, Attorney Refran. Over to you, Commissioner Amatong. Go ahead, please.
Yeah. Thanks, Mike. Good afternoon to everyone. Let me just find the screen that I'm supposed to share. Thank you again to the organizers for inviting me to be part of this forum. I think the challenge when you're the last speaker is that everybody said everything more or less beforehand. So I'm going to try to let me adjust this. I'm going to try to connect to what everyone has said already and hopefully still make contribution to the discussion, or even though we've had many good speakers, great speakers, in fact, discuss this phenomenon ahead of me. And hopefully you're still awake and you're still you're still interested in this topic of the GameStop saga. I've put a slightly different spin on it by saying speculation, herd behavior that you've just also heard from Ruel Refran from the Stock Exchange, and regulatory policy. So at the very beginning, let me just quickly flash this disclaimer that we do at the SEC, just to let you know that from here on out, these are my own personal views and not necessarily the views of the commission itself or the commission as a whole. So GameStop and meme stocks during the COVID-19 lockdown. I think we've heard from both Anton and as also from Dino that with the lockdown, people are at home. They're buying things online. They're transacting online. And if you're in the United States and some other jurisdictions, you might also have some stimulus support checks. You may have some form of unemployment insurance. You may have access to funds, even though you're stuck at home. And this coincides, this access to cash while people are at home and transacting online seems to be the start of this phenomenon of investment in meme stocks. And meme stocks, so although we're talking this afternoon about specifically the GameStop phenomenon, it doesn't seem to be limited to GameStop. There is a certain phenomenon, particularly in the United States, but also in some of our neighbors, where people are investing in things apparently not necessarily because they expect a financial return. It would appear that people are buying shares or making investment decisions not necessarily with a view to maximizing their profit. And you see that for GameStop, and you'll see that for AMC Entertainment Holdings. For those who are not familiar, AMC is a very, very large theater chain in the United States. And right now, as you can imagine, same here as in the Philippines, movie theaters are not doing good business. But you'll see that there's been a spike in investment in AMC theater holdings despite the pandemic. And then you also have another brick and mortar retailer, Bed Bath and Beyond, whose business model is being challenged by online retailers, particularly during the COVID pandemic, and people can't go out and look at bed, bathroom, and interior furniture. And nevertheless, you see a spike in investment, right? So this phenomenon is observed in a number of stocks that you would not conventionally think would be doing well. BlackBerry, right? No one's been using a BlackBerry for several, for a couple of years now, 2 or 3 years now. And nevertheless, there is a perceived phenomenon in the United States where because people discuss investing in these stocks, and possibly for reasons other than maximizing their profit, but maybe out of a sense of nostalgia or out of a sense of brand loyalty, you find people investing in these companies. And as we've heard earlier today, GameStop seems to be one of the key examples of this meme investing phenomenon, where the investment decision is apparently being driven by other considerations rather than profit maximization, and influenced by internet media persons, right? So here's just a snapshot of the GameStop phenomenon, and you can see there's a huge jump when Elon Musk, the well-known entrepreneur, tweets GameStop on Twitter. He doesn't even say GameStop, and you see a reaction in the price as people pile into the GameStop stock on expectation that for some reason they expect the price to continue to increase, or that as Anton mentioned earlier, it's an act of it's an act intended to send a message or an action of protest against the quote unquote evil hedge funds, if there are any, right? So you see that the movements, the investment decisions are being driven by other than considerations of financial return. But at the end of the day, so that's just, that's one week as this phenomenon is occurring, as GameStop comes out from a low of $2.57 per share, and then leaps up to close to the 1 year high of $483 at one point, apparently intraday, right? So you have this phenomenon again: people staying at home, access to some funds, a market that facilitates or enables this kind of investment behavior, and then through some kind of social media discussion, people gather together in chat rooms on Reddit, encourage each other to invest in a business that until that point seems to be losing money and doesn't seem to have a long-term business plan to cope with the changing times, and eventually you come down. The valuation on GameStop comes down, and as of this morning, Philippine time, it was something like 51.20. Still above 257, but way below 483. If as I think Anton Berget mentioned earlier, if you bought at 400 or 300, you're hurting now that it's gone down to 50. But if you were lucky to invest at $4, $5, $10, as of this morning, you're probably still okay, right? But it seems to be at this point a bubble that has burst, right? Anton pointed out, U.S. SEC. I think the other speakers also pointed out the U.S. SEC hasn't taken direct action on GameStop as yet, but they have put out some press releases that they are examining the volatility. They're looking into this unusual, unexpected increase in investments in GameStop and AMC theaters and other similar meme stocks. The sudden action by Robinhood that prevented retail investors from continuing to buy GameStop seems to be under investigation. That's the second statement here, and of course the commitment on the part of the SEC to ensure that they will protect investors from abusive or manipulative trading activity. Now, historically, the U.S. market is a much lighter touch market than ours. So, as you might have already gleaned from the previous speakers, there are many things that they have that we don't have, but they've also slowly, over time, started to introduce things that we have introduced in the Philippine market, like this circuit breaker mechanism, where you call a trading halt after the index or some other indicator falls behind by a certain amount, or if there's some other event that's impacting the market, right? And then you notice that the latest statement from the U.S. SEC is a warning that there's a significant risk of losses arising from this kind of short-term investing behavior based on social media. And for the moment, that seems to be the action of the U.S. SEC. I would not be surprised if that in coming days, either private suits will be filed. I think there's already some cases that have been brought by Robinhood clients against Robinhood for the trading halts or the non-implementation of their buy orders. And I wouldn't be surprised if this is something that the the U.S. SEC is looking into issues of fraud, into the possibility of pump and dump and market manipulation. But the nature of those kinds of investigations really mean that it will take some time before the U.S. SEC is able to put together enough evidence in order to build either an administrative case against possible wrongdoers, or in conjunction with U.S. Department of Justice, a criminal case for violation of their securities laws. So I think, as Ruel mentioned, this is a drama, this is a saga that is still unfolding and will continue to unfold in the coming days and weeks and possibly even months in terms of regulatory action coming from the U.S. SEC. So that's kind of like a recap of the GameStop saga. Again, you've heard the previous speakers summarize it already before me, and I think the first part, the first part I want to address is directly the question that the organizers posed: is can the exact same thing happen in the Philippines? And in this case, I think there's going to be a certain amount of similarity among the panelists today. In that, if you're talking about the exact same phenomenon happening in the Philippines, then the answer would apparently be no, because there are a number of things, as already discussed, that are present in the US market that's not present in the Philippine market, like unrestricted margin trading, or people being able to put up buy orders even if they don't have the cash on hand yet to support those orders. An active derivatives market not yet implemented in the Philippines. And this idea of short selling or naked short selling, where you are able to sell stocks in a company even if you don't own those stocks yet, in the hope that when you have to cover and actually deliver those stocks, you will be able to buy you will be able to acquire those stocks or shares at a lower price later. So none of these things, which are present in the US equity market, are present in the Philippine market. So in the sense that they contributed to the GameStop saga, not something not something that can happen at all in the Philippines today. At the same time, as Roel has actually discussed thoroughly, there are a number of Roel and Dino. There are a number of existing rules that we implement here in the Philippines that make it difficult. So you have this both a circuit breaker mechanism with the PSE, where a trading halt is called for a certain amount of time. You can see on the screen, level 1, level 2, level 3. The length of the halt increases depending on the amount to which the benchmark index moves downward. And there are static thresholds. There are also dynamic thresholds on individual shares of stock. So there's actually a limit by which the price of a particular stock can appreciate within the day or decline within the day. And the idea really behind these rules, which I hope to discuss further later, is that we want the circuit breaker is intended to give investors a period of time to pause and rethink. It is possible that that the trading activity is being driven by emotion, and you're not thinking through. And so one of the solutions that we have in the Philippines is we impose a timeout in effect, right? When the market starts to move very quickly, we impose a timeout where investors can rethink and sort of calm down on their investment decisions. On the bottom portion of this slide, you'll see the rules on margining, limited, I mean, strict rules preventing undue leveraging of equity investments, something that both Ruel and Dina discussed, and the fact that most online transactions today here in the Philippines are fully supported by cash that's already there. So people can't gamble with money that they don't have. You have to gamble your own money. You can't invest or make an order based on money that you don't have as yet. There's also a wide-ranging set of rules that are intended really to prevent fraud and fraudulent practices on the market. There was a question, I think, somewhere in the Q&A a while ago that, are there rules against this idea of people coming into online chat rooms or social media platforms like Reddit and talking up the stock. Now you'll see from the slide, if you are disseminating false information, if you are perpetrating fraud, whether you're doing this through conventional means by talking to someone or issuing pamphlets or using the internet, already considered in our rules. If you are using the internet as a means of disseminating false information in order to perpetrate a fraud, you are violating the law, and we will definitely prosecute you. So that's something that's already covered within our regulatory ambit, right? But I think the more interesting question really is, could social media speculation give rise to asset bubbles in the Philippines? So some of the previous speakers already mentioned this idea of asset bubbles, where the value of an investment or the price of an investment or the valuation of the investment is much more than its true value, right? And as we saw in the case of GameStop, you have a sharp increase in the price, but that could not be sustained for a long time, and in a matter of days, it just plummets backward, and the bubble bursts. And this idea of herd behavior, social contagion, people convincing other people to make bad decisions. This is again something that Ruel Refran of the PSE mentioned. This has been with us for a long time already, a very long time. And this pattern of people listening to other people and making bad investment decisions and not really appreciating the true value of an investment, maybe overestimating the value of investment, is very old. I think Anton mentioned Tulip Mania. So there's this very, very old book that anyone looking at capital markets might want to take a look at. You don't have to read the whole book. There's just a section in this book entitled Extraordinary Popular Delusions and the Madness of Crowds, first published in 1841. And this actually talks about, among the topics of extraordinary popular delusions shared by crowds of people, they talk about economic phenomena or economic bubbles occurring in the 1700s. Okay, 1700s. Wala pang America, let alone a US market. Philippines just beginning to be under becoming a colony of Spain, just maybe midway through our history of being a Spanish colony. May mga economic bubbles na nangyayari, and this is already documented. Now, two of these bubbles, the South Sea bubble and the Mississippi Company bubble, are cases of outright fraud. No, people in power are given royal or parliamentary authority to form a company. It used to be that you couldn't just incorporate under general law. You'd need a special charter from the government. The UK in the case of the South Sea Bubble, and France in the case of the Mississippi Company. And people who are influential in society sometimes are able to convince the king or the parliament to allow them to form a joint stock company, and the company is given certain rights that appear lucrative. So in the case of the South Sea Bubble, supposedly this British company, among the things that it had was they were supposed to have the monopoly of trade with South America, which was very interesting because at the time England was at war with Spain. Spain controlled South America. So, really, what kind of trade do you expect to have with South America if your country is at war with it? And in the case of the Mississippi Company, the French king again empowers a courtier, a very convincing person to have the monopoly of settlement rights in the Mississippi Valley. And in both cases, the people behind these companies talk up the stock. So there's this picture of a Dutch singer of shares selling shares in the company. So you can imagine the people behind the South Sea Company saying, "Oh, we have the monopoly of trade in South America. We're going to make a lot of money. Let me sell you some shares so that you can be a partner in our success." Yeah, and that's a story that should be familiar to many people from time to time when it comes to financial fraud. People say, "Oh, come on, join us. We're going to make a lot of money, and you can be a part of it if you give me your money first." And you have that case in both the South Sea Bubble and the Mississippi Company. In Tulip Mania, there was apparently a time, this is disputed, but the story goes that sometime in the 17th century in Holland, there was a lot of demand for tulips because they're beautiful, they're nice, and they're ornamental, and they're rare. They were rare in other parts of Europe. So people started speculating that the price of tulips would continue to go up as their value as a kind of ornament or a symbol of wealth started to go up, but then the speculation went up and up and up, and then it became unrealistic, and ultimately they couldn't find anyone willing to pay the astronomical price for a tulip. At that time, many times a single tulip could be valued many times over the annual salary of a worker in Holland, right? So these are all historical examples of bubbles. And I think we are just as vulnerable today as human beings to the idea of get rich quick, or to the idea of, okay, let's join together with this group. They seem to have an idea on how to make money. I don't really understand how they will make money, but they say they will make money. And as Anton pointed out, the millennial concerns of YOLO, you only live once, no? I mean, this could be a once in a lifetime opportunity. I don't understand this investment, but this could be a once in a lifetime, I should join. Or FOMO, fear of missing out. Everybody is investing in this thing. I don't understand this GameStop thing. I've never seen GameStop before, but everyone's doing it. So I might as well do it as well. So this phenomenon has been with us for a long time. And I think the difference today is, instead of having a town criers or a singer of shares going around physically trying to entice people to make this kind of investment, you have social media, which allows you to reach out to a very large number of people very quickly at low expense, and share with them investment concepts that may or may may not make sense, right? And when that happens, you might get this, which is a bubble, right? People initially being egged on to say, "Oh, let's save GameStop," or the hedge funds are wrong. Let's stick it to the hedge funds. Wait a minute, we're making money. See, the hedge funds are losing. Hold on to your investment. Hold on to your investment. And then Robinhood cuts access to the market for a while, but then they find other ways to invest. Oh, it's still going up. See, hold on, and then eventually, the bubble bursts because you can't find any more people willing to pay $483 a share for a company that's losing money because its business is selling physical games at a time when people can't go out to buy retail. And as Anton pointed out, now you can just download games, right? So this phenomenon has been with us, and regulators such as myself work to try to mitigate the impact of this kind of phenomenon. But at the end of the day, your first line of defense as an investor is really your common sense. Now we're trying, right? As I mentioned earlier, as the other speakers have mentioned, we've instituted rules that try to weed out bad actors. We've put in rules where you give you a pause, so that time out, so you can rethink your investment decisions. We provide for licensing requirements, so only licensed financial professionals can make a sale and sell you an investment. The SEC last year, in cooperation with Phoenix and other associations, the IBP, all sorts of other associations, has launched a campaign advocacy network to try to promote financial literacy in the Philippines. But at the end of the day, when you're making the investment decision, it will just be you, the investor, right then and there, right? There will be no one else beside you to try to hold you back when you make your actual investment decision. And at that stage, when you're making the decision yourself, at the very least, try to hold on to your common sense. Even if your neighbor has made the investment, your cousin, or the sister of the mother of the wife of the neighbor of your cousin has reported an astronomical return based on a particular investment, try to calm down and ask yourself, a few things. Why are you investing? Are you trying to save money for your retirement? How much risk are you willing to take? Or is this just completely extra money where you don't care about the return and you just want to make a political statement? That's not really an investment anymore. You're not expecting a return. So, it's like a pseudo donation of some kind, right? How much can you afford to lose? How much risk can you take? If you put in your savings today, will you be able to save that money again, or did you need that for something like potential future medical requirements? As Anton mentioned, a lot of people apparently who were involved in GameStop were betting with their tuition money, and if they bet wrong, and you can see from the graph, it's easy for them to lose in this kind of transaction. Then they lose their tuition. They're not going to school, right? Do you understand the investment? I think the challenge many times is that you hear people, whether you know them or you don't know them, whether they are famous in entrepreneurs like Elon Musk, or some kind of social media personality who's affiliated with a Korean boy or girl band, endorsing a particular investment. Do you understand the investment? Do you know why you think you can make money on that investment? Or are you completely just relying on the endorsement of someone else who might not be able to understand your particular circumstances or the investment itself, right? Now, you should be aware that the higher the return someone's promising you, most likely the higher the risk to you. That's just really the nature of things. So every time someone offers you a high upside, there's probably a very low downside. And the last thing that I'd like to leave you with is: did you check with us? We have a campaign right now called Check with SEC, and really many times people are offered investments that are not even truly investments. They're outright scams because these so-called business opportunities are not registered with the SEC and are not being offered by people who are licensed by the SEC. So at the very least, please check before you make before you part with your hard-earned money. Please check with SEC. We're here just trying to help you try to protect yourself from losing your money. And I'll end with a paraphrase. I won't read the whole quote coming from the economist John Maynard Keynes. Speculation. I'll paraphrase. Speculation is, in and of itself, it's not necessarily a bad thing. It's part of the nature of markets that you speculate. My children speculate throughout the pandemic as to what's the best bubble tea that they can order online through Grab. No, so they try every day. They try a different brand of bubble tea. That's okay. A certain amount of speculation is okay, but when the value of a company is coming only from speculation, it's completely untethered, unrelated to its actual businesses, then we have to worry. And that's something that we worry about, not only at a governmental regulatory level, but each investor the power is really in your hands as an investor. You should be concerned also if your investment doesn't seem to make any sense to you. And I'll end here, and I'll be happy to take any questions coming from the audience today. Thank you very much for your patience. Thank you.
Thank you. Thank you, Commissioner Amatong. So let us move on now to our open forum. This portion of the program will be moderated on by Mr. Manny Ocampo. So Manny is a member of as well, together with us, Capital Markets Development Committee, and he has over 30 years of experience in capital markets. For his day job, he is the Managing Director for Equity Capital Markets of ICCP, or Investment and Capital Corporation of the Philippines. Over to you, Manny.
Thank you, Mike. Let me thank our presenters this afternoon. I think everybody is, it was a very engaging topic, and I think the presentation of Anton, Dino, Ruel, and Commissioner Epna were quite interesting. We're over 2 hours already, and we've still maintained quite a number of the people that have signed up in this seminar. So let me start. I think what we're seeing is a situation where, number one, the retail investor is, shall we say, we've seen the power, and not only in the US because of GameStop, but even here in the Philippines. Now, we've seen the rise of the retail investor as a force in the market. Now, because of this, maybe, Anton, let me throw the first question, since, bring you into the first thing, since you were the first speaker. The last slide, the second to the last slide you have, that's which is the Apple namesake stock. So I'll stay with that.
I did not say that, Manny. I blotted out the name.
Yeah, I know, but yeah, I understand. Anyway, it's an Apple name stock. But do we see a situation in the Philippines where, people like Kenneth Gill come out, influence, draw enough of an influence in social media, to to draw some kind of activity into particular stocks or stocks, not necessarily saying that these are stocks that Dino put up in his own slide earlier that seem to be the retail favorites.
Is your question whether we do have influences here who can move a stock in the retail sphere?
Yes, maybe from that angle first.
Yes, we do. In fact, we did many decades back, no? Even before retail rose to these levels of prominence and influence in the market, you had real movers out there. Now you do have them on social media. I won't name them, but there are a few very prominent ones with maybe not 164,000 followers, but 30, 50,000. You do have them, and they have a following.
Yeah. Okay. Is that something we should be afraid of if unguided? Maybe to the regulators, Commissioner F, is there something in the regulations that we need to take a look at on this perspective?
Yeah, there are 2 points here for at least from our perspective. One is the Philippines doesn't have a formal law regulating investment advisory. So there are a lot of people. I'm not sure if they're the same people Anton is referring to. There are a lot of people who represent themselves to be investment advisors or people who are investment gurus, right? And currently in the Philippines, that's totally unlicensed. It's a strange artifact of history that we never adopted the U.S. Investment Advisory Act, even though all of our neighbors virtually have, or most of our neighbors have the same act. So that's something that we're looking at. The SEC, together with the BSP, we have a bill in Congress called the Financial Consumer Protection Act, together with the Insurance Commission and the PDIC. We're supporting this bill in order to provide some kind of regulatory oversight over investment advisory. The other thing is, you're never going to be able to avoid the situation completely where someone will ask a non-professional or someone associated with a brand, is this a good investment? They're not. The person may not be representing themselves to be a guru or investment advisor, but it's the nature of meme stock that they're not asking financial professionals. They're just asking people they believe in. Okay ba to? Okay ba yung stock na to? And again, that's what I was trying to say. At the end of the day, you're your own best defense against this. Do you really want to do you want to put your life savings or the tuition of your children in the management hands of a non-professional or on the advice of just because there won't be a pure Philippine example, a football superstar or a rugby superstar? Do you think they're qualified to guide you in your investment path? Again, that's what when I was saying that let your common sense guide you on things like that.
Thank you. Anton, there was also something in the list of characters you had in your slides. The SEC was called the Spectator. Would you like to elaborate on that one? Did they really stand just by the sidelines?
I think they were stumped. No, they didn't know how to react because in a way it was a first, and the issues of whether there was market manipulation were great. In the first place, when a broker writes out a report and urges you to with a buy recommendation, uh, in a way, you could consider that touting. You are trying to influence your clients and the market buy a stock. So, what makes it different from someone like Deep Effing Value telling his investors, you should buy this stock because I believe it's undervalued? Maybe the difference is the broker is answerable to his compliance department
Right.
internally. the retail investor is policed by really no one, and that's where the SEC or the PSE should be vigilant, whether it is fake news that is being touted or not. Then the other issue there is collusion, because market manipulation is when there is collusion among investors to drive a stock up or down deliberately. And it's very clear when it's hedge funds, for instance, colluding to induce a short squeeze or to push down a stock. But what do you do when it's retail investors on a discussion forum encouraging each other to buy? In a way, technically speaking, it is collusion. But what do you do? It's never happened before. So the SEC, I think, is still trying to figure out. They've been ordered by Senator Elizabeth Warren to come up with a report on this and what resolutions they will have to prevent this episode from recurring. But I think the key here is really, was anybody propagating fake news? And in the case of the Philippines, I think it probably does happen in these chat rooms. And is there market manipulation? I think if well, I'll keep it at that, no? But I think the surveillance group of the PSE should be able to track that.
Thank you. Finally, again, about retail investors, no, and the professional managers like yourself. We've seen, for example, AC Energy. Let me bring that up. Going into the X date, there was really, that kind of activity that drove price up to about 9 pesos more or less, which I know a lot of the professional fund managers were caught unaware, or shall we say, caught off balance with their investing or trade strategies and tactics going in. So sort of, for lack of a better term, nasira discarte on the whole thing. What are your thoughts on this?
Well, to tell you the truth, I was not watching it, so maybe Dino is in a better position to answer that.
Okay, I think what happened there was that people were really attracted by this possibility of buying a stock in the rights at a much cheaper price. So people were trying to take advantage and not knowing that this will just adjust all likewise when the rights is actually made available. And that's the reason why we came out with that guide to make them understand that, of course, you're going to be given a chance to buy cheap, but that also means it will also reflect in the price when the rights are made available. So it was just that people were attracted by, wow, it's a 2 pesos and I can sell it at 9. That's giving away money. So why shouldn't I take advantage of it, right? And so that's where it all began. And that's why people were chasing the stock and trying to buy it until before the X date. That's really what it was. It's lack of information, greed driven. But they're lucky it was ASEN. They're just fortunate it was ASEN. In the past, it would have been another company.
Great. Understand, Dina. Anyway, again, maybe a question for you and what you've seen on, the rise of the retail investor. Has that affected the bandwidth and capability of your own online trading platforms? Given the number of people that have signed up and are actively trading on your ecosystem right now.
Yes, of course. As I mentioned earlier, that this was really unprecedented. We didn't really expect this kind of growth in our business. And although we keep a buffer every year when we start planning for the year, but this was much more than what we expected. I think people don't realize that there are a lot of factors that can create this lag, not only because of movement in one stock, but it was moving 5 or 6 stocks altogether, and they were moving at a very rapid motion, and it could be highly concentrated at a certain time. So all of these were all learnings that we've had. Having said that, we are making all our efforts. We're trying our best to try to make sure that we're able to, support the needs of our clients. And that's the reason why we suspended account opening and decided to just focus on trying to increase our capacities. And we're looking at that to be completed by the middle of this year. However, clients are supposed to experience these changes already now. I can't go into this. I don't think we have enough time to talk about that. But what they also need to understand, the inherent risk of a fast-moving market. That there are technology risks also. It's not only happening here in the Philippines, but happening everywhere. I'm not saying giving an excuse, but it's really part of the risk of trading these fast-moving stocks. They must understand there are limitations to technology and platforms. Once these limitations are breached, then it's all again, you have to recalibrate the whole thing. And as we grow this activity in the markets today, if we look at what happened to the more developed markets, the features are now going to be simplified in every platform because the systems cannot handle the kind of information that we provide today, which is real-time codes or broker transactions. You can see everything is this information is being thrown by the PSE so much, and that the online brokers have to process this to be able to help our clients, to give them some sense of understanding or transparency in the market. So this is, as we expand this, that's what we're learning, you'll see that we'll all have to simplify our platforms. We just have to make sure we can execute the orders, buying and selling, and give them the right quotes whenever they need to know the prices in the market, to know the price in the market. That's about it. Everything else has to be slowly being studied carefully.
Yeah. Well, first of all, let me say that I think the capital markets have appreciated the efforts of Sewell Financial in spearheading that move towards online trading. Now, having said that, the rise of the retail investor again, are we giving, well, especially the demographics you presented earlier, are we giving kids a loaded gun to play with?
I think it's not. It becomes a. I don't think it's a loaded gun that we're actually giving them. We must all believe that the capital market is a real place for people to generate genuine wealth, and by not having them participate in it is depriving them of being able to build wealth, the proper way. The only way we can protect them is really providing them the proper knowledge an understanding of how to be smarter investors. But it's not all companies are always, there are definitely bouts of speculation that will happen. We can't avoid that. We just have to tell them, if you want to speculate, there are certain rules that you have to follow, and to manage, you have to learn how to manage your risk, because you can't really avoid these things from happening. But doesn't mean we should cut them off from the market. We should allow them to continue to, participate in the market, because we all believe is the way to really build genuine wealth over the long term.
Yeah, Manny.
Yeah.
Manny, if I could add to that, I think if you'll notice, not just Call, but a number of the brokers and some of the online platforms like GCash are working now today to provide a variety of investment options to investors, not just the equity market. You'll notice even our Bureau of the Treasury has provided more opportunities to invest in retail treasury bonds, which are very low risk investment opportunities. And they're also pursuing online access to these investments to programs like bonds.ph. So the idea there really is to provide investors with a variety of investment options so that they can make the investment decision themselves. I know, part of the discussion is always how can we protect, but really when you're making an investment decision, you need to exercise the same kind of diligence you do when you buy a car or a house or any other investment. You're acting for yourself. There's only so much other authorities can do. We can require that information be given to you. That's the whole disclosure requirement. PSE makes available information through their edge system. But investors really have to educate themselves. And of course, we're partners. We're trying to provide access to that education. But investors really have to educate themselves on what their options are and make their own choices. And that's the nature of the market. It's not like going to a bank and then here's my money, give me my fixed return 2% or 1% a year, and then you lend that money out however you like it. When you invest in the capital markets or any of these investment opportunities, you're making the investment decision. Or you could, as they do in call, invest in a mutual fund or a UITF where a professional manager invests the money for you. These are the choices that are open to investors. They should be informed as to what these choices are. But at the end of the day, they need to make these choices by themselves.
Sorry, thank you, Commissioner Matong, for that. May I also, well, Roel, just just something that President Ramon Monson mentioned maybe over the weekend. No, short selling coming to the short selling as something happening maybe sooner than later in the PSE. Is that something that all considered, given GameStop and all of these things, is the move towards short selling something called for or maybe appropriate at this time, given the volatility?
Uh, Thank you for that question, Manny. No, essentially, the framework is there. I think we are moving towards a short selling framework, which would provide for more transparency in terms of the stocks on the side of the stock borrowing and lending, right? As I mentioned, covered shorts would be the adopted and the acceptable practice compared to naked shorts, which means your SBL, or we call it a securities borrowing lending program, will have to be on a more transparent basis via lending agency model. What we've seen right now is this is more on a broker-to-broker bilateral approach, and the opportunities for the other brokers as well to be able to cover their shorts would be better addressed if there is a lending agency model in place. And we're working with our regulator, the SEC, to be able to offer that prior to us formally launching the short selling program. So at the end of the day, my personal belief is short selling is probably more for the institutionals to seriously consider, less for the retail, because the institutions would have more basis for their view if that's a bearish view of the market compared to just really the chatters that going around that could probably influence a retail investor to move in a particular direction. So I think on the broker level, they would have to also consider those risk parameters on the product suitability angle. Pursuant to the SRC regulations, product suitability is a core obligation of our trading participants, because not only in the aspect of trade exposure, but at the very core, whether that product is actually suitable given the experience or the inexperience of a retail investor. So a market operator would like to provide avenues for participants to be able to implement their trading strategies. But at the micro level, the suitability on the investor side is going to be a serious concern for, I would say, for all the participants, including our brokers.
Understand. So, sorry. So it's something that won't be automatically available to the retail, especially the retail.
Can I add something?
The rules do not provide for a distinction, right? The rules just say that the parameters are such, the uptick and all that. That's why I said that's my personal observation, right? The rules do not distinguish. But yeah, I think the important framework there is the uptick rule has to be institutionalized and the covered short. So if I call my broker now, assuming we've launched it, and then the broker will have to tell me, you do not have a position, you're not long this stock. Can you imagine? I will just say, well, I want to short it, right? So I guess Dino and Anton and the others would probably be able to also weigh in on that. As we see probably certain of our retail also being probably animated by herding or any other view on the market. No? So let's probably balance also the risks as well as the opportunities that we'd like to provide. So it's a balancing of interest.
understand. Thank you. Sorry, Anton. Yeah.
Yeah, if I can add, no, I've been a long time advocate of allowing short selling. First of all, because it is very well documented that bubbles occur most frequently in markets where short selling is not allowed. Because the short seller is the countervailing force not only against irrational exuberance, but against market manipulation. You have to look to allow market participants to take the opposite view, especially here where the minimum float requirement is only 10%. It's very easy to manipulate a stock up. And the manipulators here have a field day all the time. If you had threat of a short seller capping you, it will make the market manipulators think twice.
Yeah.
The second thing, the big contribution of short selling is it promotes transparency because a short seller makes money by betting a stock will go down. So you have analysts there full time trying to uncover fraud and accounting shenanigans. So he's helping do the regulators' work for him. The regulators we know are always understaffed and cannot actively be looking for fraud in the accounting statements of companies. But the marketplace can do it for you if you just allow short sellers to go out there and examine everybody's accounts, and they will do it without the taxpayer having to even fund it.
Yeah. Yeah. Dino. Yes.
Yes, I think, Tony Rifan, I know your intentions are quite noble in the sense that you're trying to really protect the retail investor from, you might think that you're arming them with something that they may not be familiar with. But I think now that you've seen how, active and how motivated these retail investors are, I think you cannot deprive them of also trying to make money the other way around. Meaning, if they feel the markets are going down, they can't just be the only ones. It's not only the institutions that can make money, but even the retail. So I understand that we have to maybe go through a screening process, but I think if you're going to arm the institutions with this kind of facility, you should also make it available to the retail, or else they'll be up in arms. They'll say, "What is this? Why are we being deprived? And only the institutions can make money, and here we are. We have to suffer to wait for another cycle before we can make money in this market. So why are we in the stock market at all when it's not fair?" So we have to be equitable and fair even to the retail investor. That's the way I see it. It's just how we will regulate it is another, but it should be made available before it's given to the institutions. Now, if brokers can't handle it, then that's another story. But at least you're saying we're making it all available. Okay.
Thank you. Those are actually refreshing insights on short selling, and makes shall we say the available tools to investors more interesting, and allows them to hedge on things also. No, I am getting message that we've obviously exceeded our time. The time limits we have, but. Mike, are you taking over from me? Thank you very much, gentlemen.
Thank you, Manny. Thank you, Manny, and to our speakers. May I call on the liaison director for capital markets as well as one of our board members, Ms. Zondi Garcia. Go ahead, Zondi.
Okay, so good evening, everyone. So let me see. What happened? I cannot see myself. Can you hear me?
We can hear you, Zondi. There, I
Okay.
can see you. Okay.
Okay, so good evening, everyone. I really am thankful, though, that, for the past few weeks, the GameStop saga has so dominated our lives. And we felt that the story really had to be told to the Philippine investors. And I think that the lucky stars smiled on us, and we could not have gotten really the best panel of speakers to tell us that story. Anton, you promised that you will weave understandable narrative on a complex story that even your wife understood it. And I think for more than the 500 people that heard it today, I believe that they come out of this equally as knowledgeable as your wife, understanding the why and the how, what happened to the GameStop saga. And I mean, I could feel the energy and exuberance of your retail investors. And I'm really happy that you managed to explain to the difference between the Robinhood trading and your platform. And we're happy that we have the regulators, Ruel and Commissioner F, that actually made us a lot more comfortable about the goalposts that are there to make sure that people behave in a certain fashion. Now, I know there's a lot of insights that we take out of this, but let me just share the three that struck me for today. The one is really the power of the digital platform. Dino, you alluded to that already. The digital platform captured the emerging retail market, and they were given power because of that. And I think for a market to be liquid, you really have to provide a platform that accesses a broader market base. And this is really a call out to the other players out there. The top three banks have a digital platform. The market, please give coal a run for their money. The market is much bigger for them to handle. They're already saying that the market is stressed. The market is there, ready to play, and let's give them the platform that will allow them to invest in the market. But of course, with the digital platform comes digital payments as well. So they should go hand in hand. The second one is the power of social media. I think we all heard about that. This Wall Street bets and everything else. But the power of social media, I mean, that's what Spider-Man said, with great power comes great responsibility. And I think that, yes, there will be influencers who really are knowledgeable, but if it's something that is also I would say unmonitored, you will have bad players who can take advantage and do a pump and dump that will make a lot of the less savvy investors lose money. So to the regulators, I know it's not easy, but perhaps there's got to be a way. Platforms like Reddit, Google, Facebook, they always say they don't have a responsibility. But we know for a fact that an unmanaged platform can create a lot of damage. Perhaps we should find a way to calibrate that. The third one is derivatives. Just like Anton and Dino, I'm a great believer in derivatives. I really believe that to have a liquid market, you should allow two opposing views to trade their views. And Anton is absolutely right. That's the only way you could really have a price discovery. And a derivative is a tool that, if used responsibly and if you given the proper parameters, can be handled both by the sophisticated retail investor and by the institutional investor. So it's a call out to the regulator and to the PSE, notwithstanding the bad press it is getting, there is a need to have that in place. And to end this, I would just like, because everything is about Robinhood anyway. And, I was struck by the Super Bowl ad of Robinhood. For those of you who have not seen it, Robinhood paid $12.5 million to pay for a 30-second ad. And the main message that they gave there that really struck me for $12.5 million, right, dollars, is that you do not need to become an investor because you were born one. See, you do not have to develop as an investor because you are already born an investor. And it struck me because I think deep within us, all of us in our DNA really want to provide something for our future and for our children. So it's automatic in our psyche to actually make our money grow, right? So yes, we are all investors. And therefore, what we really need to do is to make sure that we have a marketplace where these investments will grow. And Anton, you have an ending line that said that, look at the company, not the stock. And I will add something to that, which I read somewhere, which I thought was also very important for tonight, is that when you look at a company, you just don't look at the valuation. You have to look at the values of the owner, and the management that runs it. So with that, I would like to say good night. Game over for tonight. And kung hey patchoy to everyone. And we look forward to a profitable 2021 investing in a bull market because it's a year of the bull. Okay, so good night and thanks everyone. Yes.
Thank you. Thank you very much, Zondi. Before everyone logs off, we have launched a single question survey. Hopefully, you can still answer it. Hopefully, you can see it all on your respective screens. So before you log off, we would appreciate it if you can just answer yes or no to this single question survey.
Isn't there only one answer?
We know.
The answer can only be a yes, right?
Again, as people are logging off, we would like to thank all of the audience members and participants. We definitely have more webinars and seminars to roll out this year. So please stay tuned for our other FINEX seminars. And just to reiterate, again, we'd like to thank our speakers. We really appreciate it. To Anton, Dino, Attorney Roel, and Attorney F, Commissioner F. Thank you very much. Have a nice
Thank you.
evening, everyone.
Thank you and good night.
Okay, thank you. Thank you. Com F, Dino, Anton, and Ruel.
Thanks, everyone. Bye-bye.
Thank you. Thank you, Mike.
Thank you, Attorney.
Okay, thank you. Buti nakahabol yung survey natin. Kala ko ginawa kanina eh.
Yes. Mike V will let us know once we are off the air.
Okay, thank you.
Thank you.